From the morning reading, stocks have been undergoing large swings on a regular basis lately. If the S&P 500 hadn't recovered into the close on Monday, then it would have marked 5 straight days with a daily change of more than plus or minus 1%. This is not something we normally see when stocks are within sight of multi-year highs. It has become more common, however, and that is a condition that was also seen before other shaky markets. There were more than 300 new 52-week lows recorded on the New York Stock Exchange on Monday, the most since September. When the S&P was within 3% of a 52-week high at the time, this was an unusually large number of new lows. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:47 a.m. Central Time, and I'm recording this in preparation for the market day of December the 8th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. We did have some pretty interesting action last night. And indeed, things are pretty weak. Yesterday, of course, was weak. It did get a bounce, as you heard in the morning reading, right at the end of the day to come up off the lows. But again, weakness in the overnight. At the time of this cut, the S&P futures were down nearly 14 points, or about 2/3%. The Russell even weaker, down about 0.75%. Nasdaq down almost 0.75%. Dow down about 2/3%. In terms of crude oil, it's up about 0.75%. Euro is nearly scratch, and you have bonds also near scratch, and gold down about 0.33%. Couple comments about these futures contracts. You have the 4 U.S. indices. They'll probably be in rollover Thursday and Friday, with the majority of the volume being on the new March contract probably on Friday. Things can get pretty choppy during rollover, so be aware of that. Poor follow through oftentimes. Also, the euro looks to be getting ready to roll over, so numbers can be a little wonky sometimes as people are trading between the different contracts. In terms of overseas action, China down almost 2%, Hong Kong down 1.33%, Japan down 1%, Germany down over 1%, United Kingdom down almost 1%. In terms of macroeconomic reports for today, you have in the United States the JOLTS job openings, which will occur during the market day, so be aware of that. And that's it for today. In terms of tomorrow, looking forward, we have the weekly crude oil inventory report at its usual spot. And I don't see anything else really for the United States of any note, so relatively quiet report there. In terms of market condition, this has been all over the place of late. While IV percentile and fear, as evidenced by the VIX, and you see the short-term VIX at a 16, is relatively low, and the IV percentiles you see in the S&P 19, also the Russell 19, only 11 on the Nasdaq and 21 on the Dow, very low levels there. We're still seeing quite a bit of price volatility, and indeed we had a 2 standard deviation move put in by the Russell yesterday in a down move. So you've had, for the last 5 trading days on the S&P, with at least a standard deviation move. That did not occur yesterday, but this is two-sided action. It's just going right back and forth, back and forth. So just kind of be aware, those are the kinds of market conditions that we are currently in. In terms of, let's take a quick look at the charts. SPX, as you see yesterday, pretty weak day. Did come off the bottom, so it's not as weak as it could have been, but with that overnight action being down about 13 points, right now we're about 2061, so we're actually down more than 13 points from the close, and that would put us Well, at 2061, that's on the ES futures contract, but we'd be down near these lows from yesterday. We're setting up at this time to come into today's action in a pretty low area. The Russell also low. It makes you think that we may be setting up to revisit these swing lows. So really need to have a higher low and to establish higher high to be able to maintain this intermediate term bullish trend. And this seems to be something in question right now. It has not happened yet, but we don't want to see a lower low here if we're truly thinking that we're going to have an intermediate term bullish continuation pattern that takes us to these former highs and all-time highs between now and the end of the year if we're going to have any kind of Christmas rally and stuff like that. Nasdaq, you see similar action, though coming off of higher levels, and the Dow looks very much like the S&P for today. In terms of volatility, you see the action so far today. This is the futures contract, so this includes today's action. Things are moving up, and we're up almost to an 18 at this point. And I always kind of think of a threshold right there about the 18 level. When we start popping up over 18, up over 20, that's kind of the bear market trend territory, not bull market trend territory. So we're not there yet, but certainly this is a bit more weakness than some people had wanted. That's for sure. In terms of bonds, they've been stepping up. Let's go ahead and look at the futures contract and see what we got going so far overnight. Things are stepping up in the bond market near yesterday's highs. So things are starting to become a bit more defensive across a number of these contracts. In terms of our regular daily report, we still are calling this phase 5, the break of horizontal diagonal support. We still have a lot of weakness here for something that a lot of people want to still call bullish market. IBD status remains uptrend under pressure. The accumulation distribution score for the S&P dropped to a C-, the Nasdaq to a D+. The GMI index still retains the buy signal, but it has only a 4 out of 6. That author continues to remain largely in cash. Primary market condition based on moving averages and their relationship remains in a neutral bear. In terms of stock charts decision points, we continue to see a lot of chop on the short and long term, while the intermediate term has up to this point been able to retain a bullish stance. The intermediate term market posture is bearish, but still retains an upslope sentiment. So the consensus of all this retains that kind of transition phase, and we still have yet to determine whether this is going to transition into bear market or transition into bull market when we get the stack of these time frames in agreement. A few days ago, of course, we would have said that we would have had a bullish bias. That's starting to get more and more questionable now, though I will say that in bull markets we often look relatively ugly just before the bulls come in and retake charge and take it back up. So right now we are still retaining that in transition with a bullish bias, but the bullish bias continues to deteriorate. In terms of position sizing opinions, you see that deterioration being reflected in these systems. Both opinions now calling for 50%. So that should be another warning sign to you. Other warning signs are the intermediate term market posture is now on 3 of the 4 indices in a bearish mode, and the Nasdaq is just barely hanging on to a bullish intermediate term market posture. In terms of head warning status, we're currently at level 1, which is our yellow light or cautionary level. This is not high risk. That would be more like 2 or 3, but certainly these risk conditions continue to elevate. This does not mean it's a prediction that the market's going to break down or how far it's going to go, but it does say that risk conditions are elevated, and you should be making more defensive moves with your portfolio and your initiation of positions decisions as a result of that. And indeed, when we start breaking down where some of these things come from, we got a lot of warnings coming from our below indicators. In the volatility bucket, market and decline, sharp increase warning have fired. Distribution day count, and the Nasdaq is now at an 8. Skew remains elevated. Fear still doesn't seem to be here. We don't see anything here from the VIX being, elevated or anything like that. We also don't see the next this week's expected move being terribly elevated. Now, if you go into the next week where we have the Fed announcement, that does pop into the 40s, but for the rest of this week, it still remains relatively small in the expected move. New York Stock Exchange, new highs, new lows. We had a reference to this also in the morning reading. Look at this, 582 new lows for the month yesterday, and over 5 times the number of new highs. So clearly not healthy bull market there. Also, the key intermarket risk aversion indicators, we had one of these as risk on, but that flipped back to risk off with yesterday's action, and now all 5 of them are risk off. Fear and greed index has moderated a little bit. It's now a bit more neutral. In terms of the special opinions, no changes from yesterday. VIX is still inside the acceptable window, so it is okay based on that metric to initiate new positions for option income strategies. Just kind of keep in mind that with these price volatility that we've been experiencing, not necessarily volatility in the VIX, but in price, that you got to be pretty ready to be nimble around delta or even vega changes. We could see a pop, an increase in vega with the current market conditions, and you need to be prepared for that. If that is not your ideal niche for trading option income strategies, you might want to stand aside or at least reduce your position size. More aggressive and experienced traders will find that the increased premiums and price action actually presents opportunities. You just have to be ready with your adjustment strategies and kind of feel confident that you know what you're doing with that and have the capital to make those adjustments. In terms of cover call strategies and put selling, no changes from yesterday. Conditions are not acceptable to initiate new positions for novice traders on either one of those strategies. Aggressive traders may want to use a range of defensive postures to be able to craft your positions and take advantage of some of the opportunities that might be presenting. But as always, keep that position size in the scale that you are willing to own if you are doing put selling especially. So that should, we got one other thing here. Our sector specific, yesterday we did have some positive. Utilities were up, consumer staples and telecom. Those are not the sectors that you look for to be the leaders when you're in a strong bull market. These are more defensive, so you should be taking note of that. In terms of percent change, and I think I got these flip-flop. Yeah, I got these flip-flop. But anyhow, in terms of sector-specific, short, intermediate, and long term, based on our market postures, you see consumer discretionary, consumer staples, healthcare, financials, and technology still retaining a more bullish market posture. And certainly technology and financials have been relatively consistent, as would consumer staples. And then on the downside, we've been seeing a lot of weakness consistently out of transportation, energy, and retail. So kind of keep that in mind as well. Let's see here. I think that's probably enough for today. As always, if you find that what you're getting from here is helpful to your trading, we greatly appreciate you subscribing to us on the YouTube channel. That also provides for you the opportunity to get a heads up when the content has been posted. Also, another way to acknowledge and share with your trader community is to retweet us to your Twitter followers, your StockTwit followers, and the like. You can send direct comments to support@falconglobaltraders.com if you'd like to do that. There are a number of other special opportunities here, and perhaps I'll mention this one here today. Continue to make progress on developing this covered call mastery course, and was looking at the calendar yesterday. I'm kind of thinking at this point that I'll probably start this course at the end of January, run for several weeks on Saturdays. But if you've got an interest in this, this will be a comprehensive course. Complete rules-based trading strategy will be provided by the completion of this course. Be able to know how to properly screen stocks, do the technical analysis, look for the entry setups, do the various calculations. Also have a complete understanding of exit strategies and all the different permutations that can happen with covered calls. Of course, covered calls is a very conservative strategy, and it's oftentimes the kind of intro to options. It's actually more conservative than owning stock by itself, as you actually reduce your cost basis and your break-even line with the strategy. So better to own Apple with a covered call from a risk standpoint than it is to own Apple without a covered call. You actually have a riskier position in that circumstance. Now, it does have pluses and minuses, and we'll certainly go through all of that with the course. But if you've got some interest in this, go ahead and just send us an email to Steven@FalconGlobalTraders.com. I'll put your name on the list, and then when we are ready to release the details, we'll be sure to include that announcement to you. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And of course, this hyperlink right here takes you to the full disclaimers. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.